What is up, everyone? Welcome back to the trading world. Today we're going to be reviewing price action for yesterday, September 19th, 2025, covering price action in detail. If you guys enjoy the content, definitely consider leaving a like, subscribing, following me on X, and checking out my completely free Discord. The link to that is in my bio. So, yesterday we continued to expand up, and so your first thought might be, Jake, why didn't we get TGIF set up? And if you guys don't know what that is, it's when we have an expansion week and we expand all week. A lot of the time, what will happen is on Friday, it's specifically only on Friday, we will retrace back into that weekly range, right? And this is also vice versa for if this was a bearish week, right? We would go up and then go lower. Go up, go lower, and then that last part would retrace. But note how we did not get that this week. And a big reason why is pay attention to the higher time frame, right? We are in a clear higher time frame expansion. Remember how last week we talked about this weekly candle exploded upward and we got a candle body close above this high. So if we go down to the 4 hour, we're actually holding a propulsion block right here, 4 hour OB, and then 4 hour PB, right? There's PB, and then here's the propulsion block, here's the order block. And you can see we barely tap into it, and then we are aggressively expanding up, right? So right now, the market has no intentions of going lower, so because of that, TGIF's just not really necessary. It's not necessary because we're expanding so aggressively. So order block, propulsion block, and then we start to expand. Look how perfectly we react off of the propulsion block there. So anyway, then you'll note here we have a daily fair value gap, right? This ends up getting held perfectly, daily gap, and then dropping down to the 1 hour, right? See how we got a buy model off of this daily gap here. We can actually measure out the bodies here of this manipulation. You can see how we perfectly go to the first standard deviation, the second standard deviation, and now possibly we could be on our way to the third and fourth standard deviations. Note how I measured this out here. I measured it out from body to body because this is just such a long wick. I don't want to use the wick. So with that, guys, let's talk about the actual price action on Friday. Once again, higher time frame. We are just expanding higher. Don't fight the trend, right? So essentially what we're looking for on the lower time frame is we are looking for basically any gaps that are in discount to expand us higher. And so the first one that is super obvious is we had from this low to this high, we had a 1 hour gap here that was in discount, right? And we need to cut through candles with these gaps. So even though we wick through this gap initially, right, this gap is still going to affect price. And that is a common misconception that I had when I first started trading. I thought that when you have a gap like this, I thought that the first time you react off of it, it was done. That's not how it works. These gaps are referenced over and over again, and they cut through candles. And anytime a gap is used, after it's already been used once, it's actually called a reclaimed fair value gap. I made a video on this before, but just so you guys know, I called it reused fair value gaps before. There's actually a technical name. It's called a reclaimed fair value gap. And then looking at price action here, you can see all of a sudden now things start to become very clear because what happened? Going into London session, we create low of the day, and then we get a break of structure higher. That should ring a bell, guys. When London makes low of the day, what's likely to happen? Let's pull up my daily profile chart. You guys should already know this because I talk about this in so many videos. When London makes low of the day, let's scroll up. When London makes low of the day, pushing into a higher time frame key level, New York's likely to continue, right? London low of the day, New York continuation. That's the most common daily profile, right? When London sweeps Asia and then continues higher, New York's likely to continue. And, well, you can see here, that's exactly what happened. In fact, you could even mark this out as a 4-hour gap, 4-hour implied gap, where you merge these. An implied gap is when you basically look at two candles and you just say, if this was, if these two candles were merged together, it would essentially be one fair value gap. And I just do that because conceptually, it makes sense to treat two candles as one and then make that a fair value gap, right? So 4-hour implied fair value gap. And then you can see this 15-minute change instead of delivery here perfectly marked the low of New York session, right? Pretty cool. So this is the model that I would have had framed for the day. 15-minute change instead of delivery off of this 4-hour implied fair value gap. And pretty clearly you can see accumulation. This entire range is accumulation. And then we have manipulation of this low, right, with a sweep. And I have images of this, so let's just pull it up, right? We have, I believe it was this. Wait, let me look around. So here's one version of it, right, where all of this, all these highs, now that we've gotten change instead of delivery, all these highs that were once high resistance, right? As we haven't formed low of the day yet, these are high resistance. But then once we come down, fill the gap, and then get change state delivery, now these highs switch from low resistance to high resistance, and then we push back into the change instead of delivery off of the 1-hour gap, induce the low, and you can see how this was a sniper entry, right? Inducement of the low into that 5-minute change of state delivery, and this is a 1-hour gap, by the way. So 1-hour gap, 5-minute change of state delivery, we create a swing low. You can put a limit order right below that swing low, and see how perfectly we induce that, right? It's like literally perfect, and we go straight up to go run those low resistance highs. But then as well, you could take this with a 4-hour, 15-minute model, right? So all these models kind of, work hand in hand, right? You kind of just have to be able to read the bias and read the draw on liquidity. That's what matters. Past that, the specifics of what model you use, it's kind of up to you. So we have accumulation, manipulation of Asia's lows, and then change in state. We get one change in state here. If you wanted to take this, that would have been fine as well. It looks pretty nice. You can enter on the close there. If I entered on the close, I'd probably have stop loss there. And then you could target the end of those low resistance highs. But once again, you could have also taken this. And here as well, if you have conviction that, we have a gap here, you could maybe not have a full size stop loss. It just kind of depends, right? Just depends on your conviction. But what I think is really cool about today is today was a very, very great learning experience about the difference between high resistance liquidity and low resistance liquidity. Check this out, right? Here, look how perfectly we fill this gap, by the way. Boom, fill the gap, and then we get the change in state. But here's what I want to talk about right now, right? When we're on the left side of the curve, when we haven't yet gotten the low and gotten a change in state of delivery on the higher time frame, all of the highs that form are going to be high resistance, right? So you're going to actually want to trade against the low resistance, what looks like low resistance liquidity, but it's actually high resistance. You want to use high resistance liquidity as a confluence to trade against when you're on the left side of the curve. Then when you get to the right hand side of the curve, you want to go trade to run that old high resistance liquidity, which now is low resistance liquidity. So once again, while we're on the left hand side of the curve here, this is high resistance, where every single time we push up into it, high resistance, high resistance. It's literally it's a high resistance curve. You see how the bodies all respect this high resistance curve? Then finally, once we get our change in state of delivery, now the market has that go sign to go run this now low resistance liquidity, because now we got an obvious change in state of delivery on the aligned time frame of our higher time frame model, right? 15-minute change in state of delivery out of our 4-hour implied for value gap. So now we're ready to go run liquidity. So now you want to trade with the higher time frame model. And same exact thing happens during the actual New York session, right? All through here, we are having high resistance liquidity, right? You want to trade against this. Trade short while you're still generating this high resistance liquidity, because we have not yet formed a low into a higher time frame level and gotten a higher time frame change state delivery. So all of this, high resistance. Trade against what everyone else is thinking is low resistance liquidity. This isn't low resistance yet. This is high resistance. Then once we come down, push into a higher time frame key level. Here I would consider it to be this 1 hour. There's a lot of different ways to do it. Once again, it's not necessarily an exact science, but the way I would mark it out, I like using fair value gaps. So I would mark it out like this, right? Combining these candles together as one, and then this would be like a 1 hour gap to me. And it's also an order block too, and a breaker. Choose your way you want to mark it out, right? But I'd mark it out. You could also mark it out like here with this breaker, right? So 1 hour, let's say you marked it out as a 1 hour breaker, right? Meaning a breaker block, by the way, guys, is when you have a low, high, lower low that sweeps liquidity. Why is this a nice breaker? Because it comes before the sweep that takes out Asia's low, right? Anytime you have a breaker that took out a key low, like Asian session low or London session low, it's going to be very nice. Now you guys might be wondering, why am I not using the whole wick? Why am I not using from wick to wick? Because guys, this is like not useful at all to me. So I'm just going to mark out the useful part, which to me is from the wick to the end of the body here. And you could even mark it out as just, the highest of closed candles body. Whatever you want to do, honestly. Anyway, 1 hour breaker. Personally, I'd mark it out from the top of this wick to the body. That's just what I would do. And then on the 5 minute, right? So we have a 1 hour breaker. Now we push into this higher time frame key level. Check out our time levels, by the way. Our true opens. We perfectly sweep out midnight, which is our true day open. And we perfectly sweep out 7:30, which is our true session open. Now that we have successfully swept out key times, the market is now ready to turn this high resistance liquidity into low resistance liquidity. This is why true opens are so important, and not just true opens, but time levels in general, right? Pay attention to, when the market dips below key times and then reverses, because it's gonna be super helpful to identify where the manipulation happened, right? Here's 7:30, here's midnight. Notice how we swept out both of those. And then now, let's get rid of this. So yeah, there's the manipulation of this low here. And see how useful it was to figure out where the manipulation was, right? Now that we had midnight marked out and 7:30 marked out, we can clearly see, oh yeah, there's where we manipulated, because we dipped below midnight and 7:30 and we swept out all these lows here. And once again, we already had a bias for the day of being bullish because our daily profile was London low of the day, New York continuation. So now we have midnight that we swept, and we have 7:30 that we swept. So now we get 5-minute change in state, which is our aligned time frame with a 1 hour. Whether you had this a 1 hour order block, a 1 hour breaker, a 1 hour gap, it doesn't really matter. It's still all the same. So here's a 5-minute change in state. And let's mark this out like this. And you can enter right on the close here. That's probably what I'd do because it's pretty obvious we're going to go run higher. And oh my gosh, this is my favorite part of the day. Check out when this happens. Check out when this happens. It's going to blow your mind, guys. When do we get our move higher? Right at 11:50. And we hit our draw on liquidity at 12:10. What's that? That's our lunch macro. And I honestly, guys, I never realized how powerful the lunch macro was until just recently. Like when the market, check this out. When the market is generating liquidity in the later half of AM session, and then let's say we sweep our true opens going into the lunch hour, and then we get a change in state. Now all of a sudden, this low resistance liquidity, or high resistance liquidity becomes low resistance liquidity, and the lunch macro is going to work best in situations like this where the late morning was just generating liquidity, right? From like 10:30 until, or like 9, from 9:50 until like 11, we just been generating liquidity. When is the lunch macro going to be good? I just marked this out. When is the lunch macro going to be good? When the late PM session was generating liquidity. See how late PM was generating liquidity? We got that 5-minute change of state delivery I talked about. And then look, the lunch macro from 11:50 to 12:10, perfectly delivered price to go run up to that low resistance liquidity. Very, very cool. And then look at this SMT here, right? We get SMT with midnight, which you guys may remember is very, very important. You want to see that for your bias. We get SMT with midnight. Bang. So I think that was where the SMT was. It might be, yeah, it's right. I think it's right with that. And so anyway, you can enter right on that 5-minute change state delivery close. Another way to have taken this trade with the same idea is you could have used a 15-minute gap or implied gap right here. Let's see. I'd mark it out like this. From this, merging these two candles together, right? 15-minute implied gap. And then same thing. We dip below 7:30. We dip below midnight. And guys, once again, sometimes if you don't have the aligned time frame key level, if you're confident enough we're going to go run liquidity, you can just enter right on the change in state, right? So like, let's say you were confident enough we were going to enter or run liquidity, and you couldn't find the the aligned time frame key level, you can just enter on change in state here. And the reason is because it's the same as like an inversion for value gap, right? Inversion for value gaps, we don't use key levels, so change in states, why should you need key level? You don't necessarily have to, it's just, it makes it higher probability, right? So 15-minute key level, 1-minute change of state of delivery. And as well, we also get a 1-minute change of state of delivery here. See how we backtest that? And you can put stop loss there. So you can enter on a limit order retesting this 1-minute change in state. And now all of a sudden this is 6R. Right? Crazy stuff, guys. But you'd have to understand this was manipulation. How could you figure that out? Because we swept midnight, which was the true day open, and we swept out 7:30, which was the true session open. Then with that, guys, yeah, we just continue higher. Once again, these markets, guys, they're sometimes up to your own interpretation, because as long as you have the bias right, how you enter, it doesn't have to be an exact science. It's more of just like, can you identify the AMD and then align time and price to know when we're ready to go run liquidity. That's really what it is. Trade on side with accumulation, manipulation, and then distribution. And to go back to the thing I was talking about with the trading with high resistance liquidity, right? You might be wondering, how the heck could you do that? Well, I actually have a clip from my live stream because it's kind of cool. I tape read like almost a perfect trade. It was crazy. Like, I tape read two almost perfect trades, actually. Let's actually pull it up here. It was this day.
Hit the highs.
Okay, let's run back. So check this out, right? I identified this as high resistance. Why? Because obviously every single time we came up to this curve, we had been failing to break through it. We'd been failing to break through it over and over and over again. And so when we hit this high, this was a 15-second change of state delivery from a 1-minute key level. So I saw that as likely to be an inducement because it was in line with this high resistance liquidity. So check this out, right? Once again, the key level I used. Now, the thing about this is you could have used a lot of different things, right? I think what I used was this 1-minute breaker, but that's not the most obvious one. I'd probably say the most obvious one would be this 1-minute gap, right? We had this 1-minute gap, 1-minute reclaimed gap. And then off of that 1-minute gap, so I wouldn't even use that breaker that I used in the video. Off of that 1-minute gap, once again, all this is high resistance. This is a whole high resistance liquidity curve. So how do you trade in line with this high resistance liquidity? Well, you frame a sell model on the lower time frame to go target sell side. So 1-minute fair value gap, it's a reclaimed fair value gap because we had already used it once and now we're using it again. And then we get 15-second change in state. I align 1-minute key levels with either a 5 or a 15-second change in state. And yeah, you can see that that was a perfect high. And I had a limit order right above this high. Right, so 1-minute key level, 15-second change in state. Here's that old high. We induce it and we deliver lower. Check this out. Right. I had this marked out as the 1-minute breaker, but once again, I think this was more obviously a 1-minute gap.
This is just a thought. Like, what if we induce this high and then go lower?
Once again, this was a really obvious change in state delivery, right? And we had an old high that was perfectly placed there. So it just looked obvious to me. So check this out. Once again, framing out that we had high resistance liquidity and that, this would be perfectly in line with that high resistance liquidity. So let's go ahead and skip ahead. There we induce the high. We hit that first standard deviation, second standard deviation, third standard deviation, and then finally that fourth standard deviation.
Can I explain? Yeah, so
that was 4R had I had measured it from the high of these bodies here. So from that high down to 4R, bang, trade. Everyone else is trying to long this, right? Because they see, oh, low resistance liquidity. No, we know that we haven't formed the bottom of the model yet. So we're going to fade everyone. And everyone else is thinking this is low resistance. We're like, no, this is high resistance. And actually, we need to get a higher time frame key level. And then a higher time frame change in state of delivery. Makes sense, right, guys? So we fade everyone thinking it's low resistance liquidity because it's high resistance liquidity. Then once we form the bottom of the model and we get our aligned time frame change in state of delivery, that high resistance liquidity is now going to be low resistance, and then we're going to take an entry to go target those highs. So pretty cool. Sorry if I'm kind of like it's I wish I could make it so like it was just simple, but guys, it's a lot of it is just not simple. So, but we're trying our best every single day. And then the other trade that I caught that was 4R was the same exact thing, right? High resistance liquidity curve. You can just tell when the market's high resistant. So we're gonna use this to our advantage. We're gonna trade against this high resistance liquidity and target sell side again. Once again, in this case, we had low resistance lows right here, right? We had low resistance lows at sell side. So we're using this high resistance liquidity as a confluence. Guys, once again, this is not easy stuff. This is hard. I'm not saying it's easy. But high resistance liquidity, we had a 1 minute propulsion block where here's obviously, this is the series of up close candles, right? So here's I think it was a 1 minute. It might have been a 5 minute. Hang on. It actually might have been a 5 minute. Maybe it was a 3 minute. Yeah, it's a 3 minute propulsion block, right? We had a OB here, so the highest up close candle here, and then we push up into it again. So here's OB. Here's an order block. Once again, what's a propulsion block? It is when you have an order block coming off of another order block. So here's order block right here. Here's a propulsion block right here. And notice how we tap into it, right? We tap into it. So this is how you trade a propulsion block. You have a 3 minute order block, a 3 minute propulsion block. We take an aligned time frame change state delivery off of a propulsion block. That's all you do, right? All you do is you find the order block. This is a 3 minute order block, 3 minute propulsion block. We drop down to the aligned time frame. For me, I like the 15 second. Maybe you could use the 30 second, but with a 3 minute key level, I would do like 15 second change in state. That's just what I would do. And let's go ahead, figure out where this was. There it is. So high resistance liquidity curve, right? All through here. Every single time we push up against it, we can't break through. So we know that this is likely just going to be another failure swing. So 3 minute OB, 3 minute PB, 3 minute propulsion block. Now we look for 15 second change of state. We actually get a sweep of this high here. I'd actually mark it out like this, because this is like equal bodies and an equal high. So sweep of that. We ended up getting SMT with this high, in line with that high resistance liquidity curve. And then I actually might have used a 30 second. I think I did, yeah. So once again, either 15 second or 30 second change in state. I used a 30 second here. 30 second change in state. Then you can enter right on that close. 30 second change in state. And once again, I told you guys we had low resistance lows right here. Low resistance lows. You can just see them on the chart. So logically, I just targeted those low resistance lows. 30 second change in state. You guys can watch me tape read the second 4-to-1 trade that I took right after this. Check this out. Alright, not that one. So, there we go. Swept out this high.
This is just a theoretical trade.
So we had that. I guess I marked it out as a 5 minute order block, 5 minute propulsion block. Now we had SMT with that high, liquidity sweep, aligned time frame change state of delivery off of the propulsion block.
SMT at the highs. So this would be, yeah, I would enter here. So I'd enter 32, and then I'd enter one macro. And then on Apex, I put a limit order, let's say, so 496. So 24 times.
I've gotten better at calculating my risk since
96, right?
since yesterday. I've been practicing at work all day in my head. I just like calculate.
Yeah, so 96 on Apex. You gotta get a little better at that.
How to convert the contracts to each of the different
Stop at the end
accounts.
of the green candle, and then I target the fourth.
And then you can see here, we deliver to that second, and
Hey,
we end up delivering to the fourth.
you have to really know what you're freaking doing. That's what it is.
We end up delivering to the fourth later on. Here you can see this is how I'd measure it, right? I'd measure it from body to body here. And you can see we end up delivering to the fourth actually perfectly right there. So once again, market maker models, they end around the fourth and the fifth standard deviation. But here this is nice because the low resistance liquidity, it essentially ends right around that fourth standard deviation. But as well, in this situation, it might make more sense to have taken profit at all of these lows, right? Since these were equal lows. So honestly, in hindsight, I think the best place to take profit was probably these equal lows, right? Pretty obvious this is equal lows here. So 30-second change in state, and then you can just target those equal lows. Once again, guys, know the market conditions, trade the market conditions. If it's low resistance liquidity, you want to be targeting that low resistance liquidity. If it's high resistance liquidity, you want to pair your trade against that high resistance liquidity. And that's what no one else is going to tell you, but it's what I'm going to tell you because, yeah, I actually want to help you guys, and I'm not like everyone else that's just trying to lie to you. I want to actually help everyone. So, yeah, with that, guys, you can see equal lows. And once again, guys, if you don't know equal lows, they are really strong target, right? If you ever see perfectly equal lows like this, the market loves to come back to them. So 30-second change of state, perfectly down to those equal lows. And this is also during the macro time. So it doesn't get much better than that. With that, guys, hopefully you guys enjoyed this video. As always, there's like a million trades you can take every single day. It's up to us to identify them, find them, and yeah. Let me know if you guys enjoyed this video, and I'll see you guys in the next one. Peace out.